I want to introduce the quarterly conversations. It's Rick Bell and Dan Brady doing doing our quarterly conversations for the quarter of 2020, first quarter of 2024, where there's a lot of interesting things to talk about. Dan is the author or the primary author of our quarterly newsletter, and he also puts together the slides and conversation that we're going to start with today. So we're gonna basically walk through the slides. Dan's going to walk through the slides. I'm going to try to be quiet for the first 15 to 20 minutes of the program, and then we'll get into some more conversation. Just to give you a little insight, the market was up about 26% in 2023. 57% of that increase came in the last 2 months out of the year. We are going to talk a little bit more about what really drove the market, and what can we expect the same for this year. Is inflation really slowing down? We can discuss a little bit more of what drives inflation and what have been the drivers of inflation, and are interest rates going to go down? The Fed expects to do 3 cuts this year, and the market's predicting 6. Who's right? Who's wrong? The Atlanta Fed actually came out. Raphael Bostic came out just recently and said that the first rate cuts are going to start in the last quarter of 2024, which is much different than what a lot of the analysts are talking about today. So Dan, why don't you take us through the process, through the slides, and then we'll have a little bit more discussion afterwards.
Yeah, sounds good. Thanks, Rick. And thank you everybody for joining today. If there are any questions that come up during the slides, please feel free to use the comment box or the chat box or the Q&A box. I think what we're going to do this quarter is we'll get back to them in the second part. I'm going to try to get through the charts here, and hopefully create a narrative for what we see in the markets. So let's dive right in. Rick alluded to this, but last year, market was up. S&P 500 was up 26%. I think, what I wanted to do was sort of zoom this out a bit and just illustrate some of the peaks and valleys, and really going over the last 4 years here. If you look at February 19, 2020, on this chart, which is right here, what you can see is we've had, since the recession in 08, you had a long bull market up. And then over the last 4 years, we've had essentially 2 full cycles, technically speaking, with a 34% downside during COVID, a subsequent 114% upside through January 2022, 25% contraction, 33% trough to peak, ending in December. So, really quite a bit of a whipsaw for investors. I think the interesting thing to point out here is that both of the recent bull markets, really the kind of pandemic bull market and the 2023 bull market have both been characterized by a large amount of index concentration. So these particular charts show the top 10 stocks in the S&P 500 versus the S&P 490, which is the remainder of those stocks. The headlines we're seeing for last year were the Magnificent Seven, which would be Apple, Microsoft, Amazon, Nvidia, Alphabet, Tesla, and Meta. So those top 7 stocks really drove the performance. In fact, those top 7 increased about 75% last year. And you can see here on the chart, the top 10 increased about 62. And that trend pretty much remains all the way down through the S&P 500. But if you can see this blue line, the return of the S&P 490, if you will, was about 8%, whereas the broader market was closer to 26. So you can see the disparity there, where if you weren't at least market weight in those top 7 or 10 names, we saw a fairly large underperformance in equity portfolios compared to, quote, the market, the S&P 500, because of this particular phenomenon, which this held true both in 22 and, or I'm sorry, 21 and 24 or 23. Because what you can see here is the weight of those top 10 stocks in the S&P 500. You see this box has been at above 30% since that run up in COVID, and at the same time, the earnings contribution, in other words, the amount of earnings being generated by those top 10 companies relative to the index, has plummeted. Right. So what that essentially says is most of that run up is purely based on speculation, on sentiment, and on availability of capital. So something to look out for as we move into this next market cycle. Important to realize, because of that phenomenon, even though the market as a total looks overpriced, since it is so heavily weighted in those top 7 or 10 names, broadly speaking, the opportunity set of the equity market actually looks undervalued, right? So this is a chart. It looks, it kind of goes all over the map, but going back for the last 20 years, this is showing you the percentage of stocks that are within 10% of their record highs. Currently, as of the end of 2023, only about less than a quarter, about 23% of the stocks in the S&P 500 are within 10% of their record highs. So in other words, about 3/4 of those stocks in the S&P have at least 10% or more to run to get back to their record high, which is well below the historical average of about 30%. So, broadly speaking, I wouldn't say the market is irrationally exuberant, but the index certainly looks overly concentrated. This is an important chart to understand. We're not technical analysts. We don't trade based on momentum, as all of you know. We're long term. We're buy and hold. We're strategic asset allocators. But as far as market direction goes, these are really important levels. So I talked about that market high that was set back in January 2022. We came right back up to that threshold, which is that 4,800. I think it was 47.95 or something or 49.75 was the market high. We got right back to that at the end of the year, and then all of a sudden the calendar flips and the S&P starts sputtering out of the gate in 2024. Right, we've had a lot of down days. It's been kind of sideways. So the interesting thing is the market as a whole seems a little scared to break through that market high. Okay. On the downside, that downside target where you see the key support is kind of the opposite, where technical analysts are saying, well, the market should, if you start to see it go down to that 4,500 level, you should start to see it, maybe it breaks through, but we would expect it not to go below that 44, which was what they call kind of a range-bound type of market. The reason being, typically when the market reaches all-time highs, and this is backed by some research. Ned Davis actually is where I got this from, but the average return in the market when the S&P 500 hits at least one record high in a given year, on average, the market returns 15% in that year. And the more record highs the market hits, which kind of makes sense, right? Because that means it's going up. The market tends to hit more market highs and get a greater return. So ultimately, what we're seeing here is if the market kind of breaks out of that top level, it's going to lead to more bullishness. Whereas if the market breaks through that bottom level, it's going to lead to more bearishness. So the fact that the run up at the end of the year got us back to the previous level means that we need to see something else happen, likely before the market starts to break out even further, right? So at this point, it looks kind of like a sideways trade. Depending on what happens in the economy, which this is just going off of our kind of Magnificent Seven theme here for 2023. We're going to go over what our Magnificent Seven is, which is the kind of the top 7 sort of economic and market indicators here that we're looking at and that are informing our portfolio allocation decisions. So you're going to hear soft landing. Sure, everyone's heard that. If you turn on the news, soft landing is in the news a lot. We'll talk about that. Labor market, earnings, inflation, interest rates, concentrated equity markets, and cash. We're at a peak. You're getting 5% on cash. Is that going to last? What's the right thing to do there? So first and foremost, soft landing, recession, what's going to happen? Couple of things are going on. So there's still tailwinds from AI spending. Housing market is stabilized, both good news. But lending, a little bit more cautious. Lenders are a bit more cautious. Government spending growth is likely to slow, with gridlock in Washington, slower corporate profits. So kind of a wash, which really comes back to, which makes sense, as is always the case with the American economy, economic health really hinges on the consumer at this point. And what I wanted to point out is, as far as the health of the American consumer, looks relatively healthy. Okay, but you're starting to see signs of trends the other direction. So revolving credit, I'll just start there, as a percentage of disposable income. Revolving credit is back to pre-pandemic levels. Okay, so we had a big dip, okay, with excess liquidity during pandemic. We're back to pre-pandemic levels, and the trend is an upward trend. Excess savings is dwindling. Okay, so this is excess savings created by stimulus during COVID. You can see this shaded chart in the top left. Excess savings are dwindling. So that is on a negative downtrend. There are still excess savings, but it is in fact on a downtrend. Same thing, debt service ratio, top right, on an uptrend, but again, just back to pre-pandemic levels. So none of these things really suggest an overextended consumer. Early delinquencies are probably, I would say, the most concerning, just because the levels are actually higher than pre-pandemic on auto loans and credit cards. You can see if you draw that that line over, they've actually kind of broken through that pre-pandemic level, and the trend appears to be up. So that's something to watch. One thing that I think doesn't get talked about a lot, which I know Rick and I have been talking about this, is if you look at student loans and those early delinquencies, that orange line, you can see the precipitous drop off. Now, obviously, during COVID, the suspension of student loan payments, so delinquencies went to almost zero, and you can see they remain at that level, although payments have resumed. We have not seen yet the resumption of income-based repayments, and the borrowers who have larger levels of debt have not recertified their income since pre-pandemic. So that doesn't happen until this summer. So there is likely to be some headwinds here, because we would expect, come mid-2024, that there's a fairly large delta between the pre-pandemic student loan delinquency rate and the current, right? So you're talking near zero to close to 10%. That's likely to spring back once you see income-based repayments resuming this summer when income recertification happens. So a bit of a headwind there, and trends on the other pieces, kind of going the wrong direction, if you will. But in aggregate, still not at concerning levels. So these are things to watch, but ultimately this is why you're seeing mostly, in the headlines, the American consumer is still healthy. Just have to be aware that this is what the economic outlook really hinges on at this point in time. We talk about the labor market. Okay, and and I know this is a favorite topic of Rick's, so I'm sure we'll come back to this, but I just want to get through this slide. So a couple of things here. We hit a cycle high and technically multiple decade high in wage growth. In 2022, wage growth was around 7%, close to double the 50-year average. Not surprising that we had inflation issues when you have wage growth that high. So it appears the wage growth problem is under control. That has subsided back to a slightly above 4% level, which is right around the long-term average. So wage growth has retreated. Unemployment has remained low. November 2023 reading of 3.7%. Just I'm going to stick a pin in that because we're going to come back to that. But the labor market appears to be supporting the consumer. Okay, the question here is, this is more of a leading indicator. Job openings have started a what looks like a precipitous drop from March 2022 to October 2023. We went from seasonally adjusted 12,000 to 8,700. That almost a third drop in job openings. Now we were at a massive peak, so as you can see, still at a high. But that trend where you start to see job openings drop off the face of the earth tends to lead a recession, as you can see from these other shaded areas. You see these precipitous drops. Almost every single precipitous drop, there are shaded areas, during those drops. So the question is, how prolonged will that drop be? Is this going to be a pervasive problem where the drop keeps happening, or is it going to be staved off, by growth? And obviously yet to be seen, but certainly something to look out for, as that's more of a leading indicator. Earnings are actually looking, analysts are fairly optimistic. So kind of baked into the cake, so to speak, 2024 and 2025, double-digit earnings growth projections in the S&P 500, 11% projected 2024, 12% 2025. Just as a point of emphasis, in 2023, earnings per share growth was 0.4%. 0.4%, but the market was up 26%. Okay, so that just goes to show you what I was talking about before, mostly trading on price speculation and future earnings potential, because we really didn't have any earnings growth. And the interesting thing to point out here is the earnings, revenue grew last year in corporate America, but margins came down, which reflected a couple of things. We talked about wage growth, so a higher cost of human capital, but also a higher cost of just actual capital with interest rates going up. And that's really going to be the interesting piece. If that margin compression continues because of higher interest rates, can revenue grow enough to outpace margin compression to get us a net 11-12% growth rate over the next 2 years in the S&P 500? You can kind of see the magnitude of the issue here. About half of the debt in the S&P is either floating rate, or most of it matures in the next 5 years. Okay, and that's throughout 24, 5, 6, 7, 8, 9. most of that debt was financed at, the historically low rates we've had over the last 10 to 15 years. So that debt comes due, and now all of a sudden interest rates are 5% higher than they were. Well, that hurdle to reach your earnings growth targets is all the much higher that you have to make up for that on the revenue side. So, there's kind of this maturity wall happening out there where you have a ton of debt maturing over the next 5 years that is going to be a hurdle that, firms will need to clear to justify these earnings growth numbers and justify the multiples that they're trading at currently. So that just something to look out for here. Another piece, inflation. The problem appears to be under control, at least at face value. We were at 9.1% headline inflation June 2022. And we have since come down. Now it's actually, this last reading on the chart is November. We just got December was actually 3.4%. This is showing 3.1. It's important to know that the Fed's target is 2%. So the fact that the Federal Reserve is saying that they're going to start cutting rates, even though inflation is at, in the low threes, seems to me to say, one of two things. Either they're really hopeful that inflation is going to subside, or they're going to, probably the second option here, they're going to live with inflation above their target rate of 2%. The reason I say that is because if you just take a look at the components of inflation, going back to when we were having the issues mid-2022, you see a lot of different pieces here. The green is energy. The red is new and used vehicles. The purple is food, right? This is when you're in the middle of, you go to the gas pump, and every time you go, it costs you, $5 more to fill your tank. And every time you check out at the grocery store, it costs you 10 or 15, 20, whatever. That's all but gone from the inflation reading. Right. And all of those items are the highly variable costs. So what's left is what they call the sticky parts of inflation, housing, and essentially what they call the core services, which is the breakdown on the right. And that is actually a major piece of that right now is auto insurance, believe it or not. But auto insurance, medical costs, recreation, airlines, education, communication, all these other core services. So between housing core services and something called other, that's where we're settling in at that low 3%. So any sort of supply chain shock, any sort of geopolitical issues, and you start to get little spikes in energy or food inflation, we're a little bit more cautious on the inflation front. We tend to think that victory shouldn't be declared quite yet, because it seems like inflation is settling in above the target rate in a more sustainable way, and it's going to be susceptible to kind of upside shocks. Because, if you can just look at this and take any one of these components from back in 2022 and add it to where inflation reading is today, and it's entirely feasible that this could pop back to 4 to 5% fairly quickly. So we are a little bit cautious to declare victory on the inflation front, but apparently the Federal Reserve is not. And I think that it's important to understand where the Fed sees interest rates going, where the market, in other words, the bond market, if you look at interest rate futures, where the market thinks interest rates are going, and what that means for the economy. So the dark blue line is the Federal Reserve's year-end estimate, and the green is what the market believes. So I'm going to try to call something out here. So, and Rick mentioned it at the beginning. This right here is end of 2024. So there's a 1% discrepancy between what the Fed is directly telling us they're going to do and what interest rate futures are, quote, pricing into the market. a 1% discrepancy is fairly large when it comes to interest rate, especially over the course of only 12 months. So basically, this means, by the way, an interest rate decrease is 0.25%. So the Fed is saying we're going to reduce it 3 times. The market's saying 6 times. Okay. But I think that the important thing to realize with this is the forecast that's part of that 2024. The Fed, I'm going to call out these two numbers. Okay. Unemployment rate and headline inflation. 24, 25, 26. So all of these interest rate futures and what their forecasts are hinge on really two pieces: full employment, low inflation. Those are two things that right now appear to be, quote, under control, but for the reasons that I mentioned, seem to have a lot of risk factors to them. So changes in this trajectory, especially when the market and what interest rate futures are pricing in seems to be so decoupled from what the Fed is saying is reality. This can create a lot of disjointedness in both stock and bond markets. And by the way, and we'll talk a little more about this, but you have to remember, you cut interest rates to stifle growth, right? So to an extent, when you're saying we're going to cut interest rates, it's funny to me because the narrative is we're declaring victory, we've beat inflation. But when you're cutting interest rates, that means you're needing to stifle growth. So what are you really saying about the GDP forecast and the economic forecast when you're saying we're going to have to cut interest rates? Right? It seems to be kind of counterintuitive that that's a positive narrative. So what does that mean for the market as a whole? A couple of different things. We're in a different regime now, in terms of higher cost of capital, much different than the last 10 to 15 years. So I wanted to show a couple of things. One is the last 1, 2, 3, 4, 5, 6 interest rate hike cycles, and what happened the 24 months after those hikes, after the peak of that hike cycle, to bonds, okay, which is the left-hand chart. So in every single case, over the next 2 years, typically the first 3 to 6 months afterwards, which is currently holding true, the bond market is kind of sideways, and then you start to see this uptrend over the next 2 years, which is essentially a product of rates reducing. And then the other piece, if you look back to where the Fed believes rates are going to be, we're looking at a 10-year Treasury rate range somewhere in either that 3 to 4 or 4 to 5%. We bounced off of 5%. Currently, it's in the 4 to 5% range. That may retreat back, but the point is, contrary to where we were, which was in these kind of near zero rates, and where those types of environments, growth well outpaces value simply because the cost of capital is lower. Typically, when you get to that 3 to 4% range, you start to see a broadening of performance where growth and value tend to perform close to the same. And as that rate gets higher, depending on where we end up settling, value tends to outperform. So we see this as kind of a regime change in the market, and especially in light of the index concentration that happened last year, we do believe that performance should start to broaden out to the other aspects of the market, especially those who have sustainable earnings. Lastly, seventh one, and then we'll get into some discussion here. We talk a lot about cash. CD rates have been north of 5%, touching 5.5%. 6-month CDs seem to have peaked. We were seeing 5.5. We're seeing about 5.3 right now. So what I wanted to show is those last few rate hike cycles, the last 6, what happened in the following 12 months after the 6-month CD peaked. Now, typically, almost everything is positive, but of course, equity markets, which are shown in the green, you look back to the 2000s with the dot-com bubble, they returned negative returns the following 12 months. But if you look at the dark blue, which is the bond market, bonds fairly reliably outpace cash over the next 12 months after CD rates peak. And that's important because we have been looking at those 5% yields as sort of a proxy for the bond portfolio because, if you can collect that over the course of the next 6 to 12 months, that seems like a great position for, the more conservative part of a portfolio. As that starts to retreat, something to maybe rethink and just to think of it in the most, if we're wrong, just to think of it in the most conservative way, you don't have to add a ton of risk. Even if you look at a 2-year treasury, a 1% rise or fall in interest rates, what happens? Well, a 1% fall means you're going to get a 6% return on a 2-year treasury, right? And you have to remember the interest rate market thinks that that's going to fall about 1.5%. Right. So depending on who's right, the Fed or the market kind of doesn't matter because as long as we just start to see rates retreat, you're going to get likely a better upside from really just adding a bit of duration to the treasury portfolio. You're not even really taking on any default risk. So ultimately, that's the last piece I wanted to talk about is just sort of rethinking that cash versus bond trade. And, we can get into some questions and some discussion here, but that's what I had prepared, and that's what we had in the letter.
So let's go back to the consumer report and kind of talk around that a little bit, because I pulled some interesting statistics about spending and more specifically credit cards, revolving credit. Just something interesting that popped up that I thought when I was looking at this is over 2 million people per year actually spend or run their credit cards up over $50,000. Found that fascinating. I can't understand how that can happen, but it does. But that obviously promotes consumer spending. And right now, I think Bank of America came out, I think this week at some point, and indicated they were writing off a large amount of consumer credit, revolving credit, this quarter. So they took a huge write-off, almost about 50% of their revenues or their earnings. They've taken in write-offs on consumer credit alone, and that actually joined the other 4 big banks. And when they reported in the second quarter, the second quarter of 2023, they reported going over $1 trillion in credit card debt. So
Right.
with the fact that this is starting to increase quite a bit, it in itself it should slow consumer spending down a bit.
Yes, yeah, you would think, and the other interesting part, we've is talk about that. We talked about this last quarter that the like recessions happen by the unseen risk, right? And I've read a little bit about it, and it's funny because there's not really many reliable metrics on it. But when you talk about the credit cards and consumer credit, if you read about, there's different terms for it, but you could call it like shadow banking. You could call it phantom lending. There's a lot of different terms, but essentially it's layaway, right? So it's basically like the 0% financing offers that you'll get from, whatever, online retailers or directly from the stores or whatever it is, where a lot of times, they're not actually tied to a credit card. Sometimes they are, but you can get these where that's not tied to a credit card. And, you go and you I don't know, you buy a swing set for your kids and you put it on this 0% thing, with the store or with some third party, and there's no credit check, no nothing, you think, well, how does that happen, and where does that go? And essentially, what that is that's recorded as consumer spend, right? That's recorded as a purchase, so that shows up as part of GDP. But I still owe somebody, but it's not showing anywhere on those metrics, right? So when you start to see rises in the credit card delinquencies, and with the way some of these capital financing things work on a consumer side nowadays, with these sort of non-bank type lenders out offering these 0% loans through retailers, you have to wonder, well, how much of that is happening out there? And if you start to see rises in these credit card delinquencies, like, what is that number not reflecting? That's sort of, just on the books of the retailer, so to speak.
Yeah.
Right.
And then how long do they sit there on the books of the retailer before they're actually written off?
Right. So, that would certainly be a concerning piece, because if the consumer is propping up the economy, but the consumer is leaning on some of these things, and delinquencies are starting to rise, well, that may not tell you the whole story.
Yeah. Yeah. And, and when you're talking about the labor market, and I think that was the next slide that we were on, was the labor market. So, as long as there's still employment, as long as there's the people aren't getting laid off, I think there can be a mitigated effect of writing off credit card debt and people spending. They can continue to pay it down as long as they have a job. And like you said, Dan, I think there is a lot of factors there where people are taking on zero interest rate debt and then paying it down over a period of time rather than using their cash, especially now where cash is paying us 5.25%.
Yeah, and I think so. That's why I brought up the job openings, right? I mean, unemployment is like, it's a good indicator of the current health of the economy. Really doesn't tell us anything about where it's going, right? Like, what tends to happen is, if unemployment spikes, okay, we're going to be in a recession. But you're not going to see that spike before the recession happens, right? You're going to start to see sell-offs in the market. You're going to start to see issues with credit card delinquencies. You're going to start to see issues elsewhere, and unemployment will start to spike. That's why I was looking at job openings, because that tends to lead those spikes.
Yeah.
Right. That spike just tends to be synonymous with recession. Right. If we get a spike, we may not.
If we get a spike in jobs, in job openings, and unemployment, yeah. And that's a big question I've had, because I think we can get a small spike. I think it can go up a little bit, but I also think we can I also think it'll stay fairly low. And one of my feelings is why is because we're running into that generation, that the largest generation, which is the baby boom generation, is in the midst of their retirement cycle. And they've been there since 2017, and it's going to continue to 2030. So I just saw some stats that, percentage of the U.S. population that's retiring now is 1.5% higher than it was prior to the pandemic. Pandemic pushed a lot of people out of the labor market, which caused the labor issue to begin with. But we still have a higher percentage of people that are retiring, and still, the youngest generation, the younger generation still isn't going into the labor force as fast as they can.
Right.
So, I believe that labor market can continue to stay, the unemployment rate can continue to stay low. And, we can roll into a recession with low unemployment rate. I mean, it's, we started that in the 70s when we started increasing interest rates, roll into a recession still with low unemployment rate.
And I think when you think, like, what could cause it, if there is an issue in the labor market, you have to kind of come back to, like, think back to the earnings picture. and S&P 500 earnings, what I was talking about with margins being compressed. So now it's okay, you got a hurdle there. So you got to grow your revenues that much more. I think the question is, can that be done organically, or can the margin compression be overcome just because, with the higher cost of capital and lenders being a little more cautious, and you don't even have to take this to the S&P 500 level. You could take it to, just the mom and pop business, right, level. When funding is drying up, right, for whatever, any growth or expansion plans of a given business entity, at a certain point you start making different hiring decisions, right? And that could, it may not be something that's led by the Magnificent Seven. That could start to smolder at a more local level, obviously because the labor market, we're talking in aggregate. But ultimately, the investment and the growth trajectory, I think, is really important because, obviously that's going to inform hiring decisions. And if firms start pulling back, which is what you've already seen, job openings have reduced significantly, even though they're still at a high. The question is, how much is that going to continue to pull back? Are we going to start to see job openings go from, that 12,000 number, or is it going to go down to 6,000 and just keep going down, 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 down? And if job openings start to, show that or continue that, I should say, that decreasing trend, it gives you more of a sense of where the labor market is going, right? Because people are making decisions to leave their employment either voluntarily or otherwise. And if there are less job openings, well, what happens if you can't find another job? You're unemployed, and then that rate goes up.
And that's why the quit rate has slowed down quite a bit.
Right. So, that's why you're kind of looking at those things, just because the unemployment rate tends to be the last thing to get the data. But what could cause it, could be a lot of different factors, but ultimately, it could be, again, consumer side. If the consumer is what's propping up the economy, you start to see a pullback in consumer spend, right? So you got revenue contraction versus margin compression. You get a pullback in consumer spend, the demand just isn't there anymore. Then now all of a sudden that bleeds into your hiring decisions. And eventually you say, okay, we're not going to post for that job, or we're going to have to lay people off, or we're going to have to, whatever it is. And then eventually you see it in unemployment, right? But typically that unemployment rate, it's not the first place you see that data. Nobody looks at the unemployment rate and says, oh, we're not heading into a recession, we have low unemployment. It's kind of the opposite, right? We're not currently in a recession, and we know that.
Right.
So, I think that's important to kind of play that game of is it the chicken or the egg, right? Like, what comes first, what comes second? And sometimes it's kind of hard to tell, but for sure with unemployment, we just know that right now it's not telling us that, that right now the economy is healthy. It doesn't really tell us anything about what's going to happen.
What's going to happen next? Yeah, and a lot of times these recessions are caused by shocks. I think we were just talking before the quarterly conversations that you were talking when interest rates start to go down. The last time interest rates went down, it went down in 2000, which was caused by the dot-com bubble. And they went down fairly aggressively due to the dot-com bust. And then they went down again after 2011, or after 9/11 in 2001, to kind of boost up the economy, because that was a shock to the economy. Right. And people were moving out of the cities. They were concerned about being in the cities at that point in time. And then we started moving back up again in 2007, right into the financial crisis. And the financial crisis hit. We started increasing interest rates from 2000, and I think it was 2003, 4, 2004 we started increasing interest rates, and then we started coming back down again. There you go. Started coming back down again in 2007, when the market tended to hit a high, and then we had the financial crisis, which brought interest rates down as low as they ever have been, or at least as low as they've been since 1962 or close to the 60s.
Right.
And then we started moving back up again, and that was due to the financial crisis, a big shock to the market where we didn't know what was going to happen next because banks
Right.
were closing down, and brokerage firms were being shut down, and it was all about saving the banks at that point in time. Um, and then again in 2019, 2020, we started reducing interest rate, and then the big shock was shutting down the world for the pandemic. And
Right. Right.
that it's the big question is, what's the shocker? What's the shocker that's gonna cause inflation? Because fundamentally, as you said it already, Dan, the economy's not doing bad right now.
Right.
We got inflation. The question is inflation going to continue to grow? I can tell you, one of the things that are out there, you talked about it in, I can't remember what slide it was, but the debt rolling over.
Yeah.
You were talking about debt rolling over. So I saw an article more recently that Wells Fargo was one of the largest holders in commercial debt. And we talk about, what debt can blow up as it rolls over is
Yeah.
that office debt. And
Hmm.
right now, I've heard a lot of things, in pension funds, holding a lot of the office debt, banks holding a lot of the office debt, and they're starting to roll over. They've been pushing them out. They've been kicking the can down the road a bit. Not because the alternative is, I'll give you the office building back, or you delay, my rolling over of that debt into higher interest rate, because right now I got 60% office space occupancy, and you want to roll over my debt into higher interest rate. It doesn't work. You either got to increase office space or increase the rent on office space, or you got to keep the debt where it is. So that's coming. So Wells Fargo being one of the largest holders to its next largest competitor, which is Bank of America.
Right.
So that's going to be interesting, and wondering if that's going to be the shock that causes it. I don't know.
Yeah, and it could be. I think the interesting thing is if you look at the bond market, it's when the bond market says we're going to have to cut aggressively. I alluded to this, but essentially that's saying there's a reset that the bond investors, based on those interest futures, they're basically saying a recession's coming because that's why you cut, right? You cut because you need to stifle growth. Whereas stock investors are kind of saying the opposite,
Hmm.
right? They're saying like we're seeing like double-digit earnings growth over the next 2 years. Now, somebody's wrong, and the Fed seems to be saying we're victorious. We're just going to soften the rates a little bit, but inflation's under control and we're going to remain at full employment. So, um, I don't know. They're supposed to be apolitical, but in an election year, it's kind of weird that they're declaring victory. So it seems to me that the Fed's trying to be the steady hand and kind of tell everybody that everything's okay. Stock investors seem to be bullish, although it is interesting that the market is not breaking through its high. And bond investors seem to be bearish and have been for some time with the yield curve being inverted. So the interesting thing is A, who's right, but B, it also could be maybe a little of both, right? Because it's not atypical for the market to run up at the end of a cycle before you hit a recession. The question is it going to run up more from here? Or are we back to that market high and we're kind of peter out until whatever that shock is happens? It's just the interesting thing that I'm seeing that you're alluding to with office space is a lot of, they call it like the debt wall. That debt wall is happening out over the next 2 to 3 years where you have, corporate debt instruments maturing. You have leases expiring on commercial properties. You have all of these different things happening. I think especially it's 25 and
25
26.
and 26, I think you said, yeah.
Yeah, there's a large amount. Where is the interest rate environment going to be then? And what's the cost of refinancing those whether they're leases or whatever they might be? What's the cost going to be to refinance versus what it was when you originally took that debt out? And what's the outlook going to look like? So it's very possible that, hey, bond investors are right. We are going to head into a recession, but it may be that stock investors are right too, and that the market's going to go up substantially between now and whenever that happens, right? And this is what we've been talking about for the last, I don't know, year or so, plus. Uh, and in fact, we experienced not a recession, but a technical bear market between when we really first started talking about this and now, which is, when do you actually hit the point where the tide turns and you hit a true economic cycle recession, right? Because COVID was sort of a red herring, right? You had this just major shutdown and then a subsequent injection of liquidity. And now we're finally, as you saw from pretty much all the charts that I put up, we're finally about 4 years later now back to like the market normal and the economic normal from where we were before the pandemic hit. The one remaining thing being those income-based repayments on student loans still hasn't come back online yet. That seems to be the one remaining relic of the COVID relief programs. And there's still a little bit of excess savings out there. That's the only other piece. But every other indicator seems to kind of be back to those levels. The difference now at this point, and in a way, this is a good thing. Interest rates are much higher than they were, and inflation is now seemingly at a sustained rate. The reason I say it's a good thing is because if we do go into a recession, the Fed actually has a lot of room to cut and stifle growth, right? That was not the case when you looked at this right before COVID and you looked at where the federal funds rate was since 2008. That is not a good place to be in when you have a near zero interest rate, because if you get to an economic recession, where are you going to go? And this was the experiment Japan did back several years ago when they went to negative interest rates. And that is not a place that you want to be, right? So that's actually a good thing that the rate hike cycle has been so aggressive and we seemingly are back to those normal levels, because at least there's wiggle room for the Fed to cut whenever that recession does come.
Yeah, that's actually been one of the debates back in 2016, 17, 18, and why they were trying to push rates up at that point in time, because there was nowhere to go. If they had an issue with the economy, if they had an issue that they had to lower interest rates further, the next step was negative zero, right? So,
well, imagine if COVID happened and the benchmark interest rate was 1%, right? How are you going to stifle growth?
you're negative zero.
That's not a great place to be.
Yeah, yeah. So it's a case for keeping interest rates higher, and
Yeah.
and wanting to keep interest rates higher. I mean, technically, if you look back in history, we've been here. We 5-6% is more or less the norm when you look at the average, going all the way back in history, back into the 60s. Even going all the way up into the 13 to 16% in the 80s. When you look back through history, it's been around 6%. So I think this number is more of a realistic number. We also have some more tools to work with. I mean, we have the Fed balance sheet, which is actually starting to slow down on how much they push out into the market. Before they started increasing interest rates, they started reducing the balance sheet at that point in time. Now they're slowing down. Oil prices. I don't know if you've seen the statistics on oil prices recently, but we're at 13.4 million barrels a day in production in oil. And we were at the highest at 12 and change when Trump was in, and they wanted, and the Democrats actually wanted to pull that back. And now there's not a lot of talk about it because they want to make sure they don't want it to look like they're pushing oil prices up too fast, but it's a tool that they're using.
Yeah.
And it's in both, whether you're Democrat or Republican, they're both using it as a
I'm
tool.
happy you brought that up because this comes up. I mean, this will keep coming up more. So this is also a good way to wrap up the outlook for the first quarter of an election year. Uh, um, so let's look at this. All right. So we got these. This was from this is a webinar we look at every quarter from JP Morgan. This is, and I thought these were great illustrations, and we always get the question of election years. So election years do tend to be good for markets. Okay. But having said that, the election cycle and political bias should not inform investment decisions. And here's some data to back that statement up. So number one is consumer confidence by political affiliation. You can see here are changes in office, these dotted lines here, right? So you have Republican control for that first period, Democrat control for the second period, Republican third, Democrat. So you got Bush, Obama, Trump, Biden lined up here. And predictably, right, you can see that the overall was lower during Obama, right? Because you're coming out of, and you can pretty much follow the 2008 recession. You can follow sentiment down. You can follow sentiment up with the subsequent bull market and down with COVID, right? So the overall shape of this makes sense. But the interesting thing, obviously, is when a Republican's in office, you see the red line. Republican sentiment is much higher. And the inverse is true when a Democrat's in office. Seemingly, if you look at the average annual return, really no correlation between what party is in office. It's just that sentiment seems to change based on which party is in office, but your actual results don't tend to really make much of a difference. And then the other piece of it is government control, right? So is it divided government, or do you have, majority? So this is just showing you divided government is in the gray, Democrat is in the blue, Republican is in the red, and this is showing you GDP growth and S&P 500 returns going all the way back to the 40s when the data was first available here. And as you can see, it's roughly 64. I'm just going to look at the S&P 500 really quick. So roughly 60% of the time you have a divided government, and on average, you're getting an 8% return in the market. And then roughly 40% of the time you have somebody in charge, and Republican 12.9%, Democrat 9.9% market returns. I think that we would take either of those. And it's actually interesting. There's an inverse relationship, even though the market returns under Republicans tend to be higher, the GDP growth tends to be higher under Democrats, right? So 4.0% under Democrats, 2.8% under Republicans, 2.7 divided government. So the point is really not much correlation that you can draw based on who's in office. Typically, what we just see is that an election year, and especially when there is an incumbent, tends to be good for the market.
Yeah.
Right. And it doesn't matter which party. So it's really just to say, set the political bias aside and realize that the investment decisions, it tends to not really matter which party is in control.
Yeah, I think what really matters is when a party is in control, the policies that they put into place. And I think
Sure.
the major thing that we can go back and look at, and we're at 5 o'clock, so we got to close. But the major thing that we can go back and look at is in 1999, when Clinton was in office, he eliminated the Glass-Steagall Act. And the Glass-Steagall Act was a large part of what protected banks. They weren't allowed to take as much risk in the market conditions. And that was a big protection of banks. And then we rolled over into George W., and he did nothing to change it. And that was the creation of the shadow banking industry at that point in time. And what caused, it only took 8 years for the elimination of the Glass-Steagall Act for it to break in 2008 with the financial crisis. So that's kind of policy stuff you got to watch out for that can change markets. It can cause major issues with markets. But as far as an election year, we can expect the market. The statistics at least say that the market will be up this year based on an election year.
You know, it also just add to the policy stuff. It's, you know, you're kind of in new territory with how the Fed acts. And like I said before, they're supposed to be apolitical, but it's been reported that Jerome Powell is a chairman that is very concerned about his legacy and getting things right. So
Non-political.
how the Fed acts in an election year and the public perception of the job that the Fed is doing, you know, look, at the end of the day, they're only human. They may be subjected to some bias there. So, you know, I actually think it has less to do with political party. Yes, of course, as you mentioned, Rick, policies can create an undercurrent and can create disjointedness in different industries and therefore opportunity, which is a good thing. In aggregate, it tends to not matter as much. But I think the interesting thing is, you know, how much is the Fed really is going to be paying attention because it's an election year to things that really they're not supposed to be, right? So, but I think that's our time. We went a little bit over. So I want to thank everybody for joining. And, you know, if just for whatever reason you can't join live in future quarterly conversations, we do record these and put them up on our YouTube.
And if there's ever any questions, obviously, you know how to get a hold of us. And we're happy to answer any questions that we didn't answer today. We were happy to answer at any point in time. So have a wonderful quarter, and we'll chat with you over the next couple of months.
Yep.
Thanks,
everyone.